I'd like to say that over the last 15 months, there's been a lot of uncertainty and change in the world, and I'll go through some of what's happened in the last 4 months. But this thesis that businesses crave certainty, I think, is falling by the wayside because the stock market in April hit all new highs, and the market and valuations are still really strong. Overlaying all of this has been a lot of turmoil in what's called the private credit market. And the private credit market is sort of an opaque lending business that is trillions of dollars. And it impacts all of us in the veterinary industry because these are the lenders who lend money to all the buyers of veterinary practices. The market in veterinary services has actually also struggled, just like the economy, yet valuations of vet practices stay high, just like the stock market stays high. And so what's going on in the industry? We have now seen 4 straight years of declines in invoices. So if this line right here is zero, invoice growth has been sort of -2 to 3% for all of 22, 23, 24, and 25. That's not a good, healthy industry, to be frank, when and invoices are sort of are the proxy for is demand for our services in the veterinary industry growing or shrinking. And -2% invoice growth means 2% less people are showing up every year at the clinics. And this is a huge contrast to the 2010s. Invoice growth was steadily 1% a year throughout the 2010s, and revenue growth was steadily 4 to 6%. We're seeing really strong demand for larger practices. We're also seeing that the things that we're going to close in the second quarter of 26 should sustain these multiples. Like we should be north of 13x through the full first half of the year, not just through the first quarter. Most industries that we see businesses sell at 4 to 7, 4 to 8 times EBITDA. Our industry is like 8 to 15 times. So we do really well. There are certain winners in this market, meaning there are, of the 20 buyers out there that are active today, 4 or 5, maybe even 6 of them have proven to themselves and to their investors over the last few years that when they buy a clinic, they can defy the market and grow invoices and grow revenue much better than the industry average. And we're very fortunate that it's not just one company that's outperforming the market, because if there's only one, then they wouldn't have a lot of competition on deals. But there are multiple companies that are outperforming, and that's allowing them to have the confidence to pay attractive or very attractive prices. And so when you take certain people outperforming the market and they're willing to pay up, along with scarcity value or not enough supply of hospitals to meet the demand of the buyers, we're getting what we see is a pretty robust market. The other point that I'll make on this graph is one is a little self-serving, which is this green line, which is Ackerman's market share, or what percentage of the deals that are being done are we working on. And we have all this good data because last year we did about 14% of the transactions. The year before we were 10. We did about 50. We helped sell 50 hospitals of the 350. What we're seeing, and it's important for those of you who own a practice to understand this, while the number of hospitals that have sold has gone down a lot, the broker, Ackerman, and our competitors, our share of transactions has grown dramatically, and the actual number of hospitals that have used brokers has been actually relatively consistent over the last 5 years. When deals happen in this industry, no one gets any more all cash at close. There's always some structure. As we talk to our clients, they're opting sometimes for more cash at close than other offers that may have higher total valuations initially, but a lot of that money is sort of in the future. And people seem to be asking and pushing for more cash up front. That's a trend we're seeing both with our sellers and us able to get that from our buyers. If you are a practice owner and you are thinking of selling and you're thinking about retirement, you need to plan to start your sale process at least 3.5 years before you want the optionality to retire.